Here's the thing. Wall Street wants the Fed to be married to this long-term rate cutting regime because Wall Street wants the liquidity, right? Liquidity is Wall Street's cocaine. They are addicted to it. Wall Street loves liquidity. They want more of it. It is their coke. It really is. So from that perspective, of course, Wall Street wants the Fed chair to marry himself to a rate cutting regime for the next 12, 24, 36 months. Heck, marry yourself to a rate cutting regime for the next 25 years, right? They would love that. That's, of course, what Wall Street wants. But the Fed's not going to do that. And anybody that expected Powell to do that is insane.
Hello and welcome to Being Exponential with Luke Lango, where we'll discuss the economy, the markets, technology, and lifestyle, all from an exponential perspective. I'm your host, Brooke. It is September 17th, and let's dive right in. All right, Luke, we usually film on Tuesdays, but we had to switch that to Wednesday today because of the subject that is on the top of mind for everybody that has their eye on the markets, the Fed meeting that just happened. Obviously, we want your opinion on that, Luke. Take it away.
Yeah, so the Fed just had their big old meeting, delivered the rate cut that everybody wanted them to deliver, 25 basis points. That was totally as expected. There were a bunch of people out there saying, oh, they're going to cut 50. They're not going to cut at all. It's complete hogwash. The Fed, literally in the history of futures markets, the Fed has always done what the futures market said it was going to do. The Fed does not like to shock the financial system. The Fed does not like to shock investors. If investors in the financial system prices something in, the Fed does that something. So the market had priced in the 25 basis point cut today, and that's exactly what the Fed delivered. Okay, so no shock there, no fireworks there. But then there were fireworks, both swings higher and lower on the updated dot plot, the updated summary of economic projections, the SEP, as well as Powell's press conference. So the SEP, how I would characterize the SEP, dovish 2025, bullish 2025, hawkish, bearish 2026. That the market was looking for 3 cuts this year. Today, and then 2 more into the end of the year. Fed did that. Fed cut today, and the dot plot says 2 more cuts for the rest of the year. So completely as expected. That's dovish. They didn't really hike or change their forecast too much for the rest of 2025. I think they boosted their real GDP forecast from 1.4% to 1.6%, but unemployment unchanged at 4.5, PCE unchanged at 3.0, core PCE unchanged at 3.1. So the 2025 outlook, pretty dovish. No change in inflation, no real change in employment, small change in GDP, and 2 more cuts as expected. So, or as desired by the market. So good there. 2026 is where things kind of get murky. The market was pricing in 2 to 3 additional cuts in 2026 on this idea that the economy needs additional rate cuts. The Fed said, not so much. The Fed only penciled in 1 additional rate cut for 2026, which is consistent with their forecast. They actually upped their real GDP growth forecast for 2026 from 1.6% to 1.8%. They decreased their unemployment forecast for 2026 from 4.5% to 4.4%. And they increased both their PCE and core PCE inflation forecast for 2026 from 2.4% to 2.6%. So the Fed sees better growth, higher inflation, and lower employment next year. You don't cut rates into that environment, so they only penciled in 1 rate cut. Market wanted 2 to 3. That's why you had these wild oscillations. The market got kind of freaked out by the 2026 outlook. Like, wait, you're not only going to cut rates 3 times over the next 12 months versus, or 3 times between now and the end of 2026 versus what the market wanted of 4 to 5. That's why it got a little freaked out. Then Powell came on the press conference and said, you know what, this is a risk management cut. Those were the three big words of his press conference: risk management cut. He called this cut a risk management cut. If it is a risk management cut, that means suggests that he's not really married to the fact or to this idea that the Fed is starting a prolonged rate cutting cycle. It either is a risk management cut or it's the start of a long rate cutting cycle. He went risk management cut. That means, again, he's not married to this idea of a prolonged rate cutting cycle from where we are. So the market freaked out about that. We dropped about 1% on the NASDAQ, almost 1% on the S&P, but then we rebounded because people reassessed. And I think the rebound is very appropriate. I actually walk away from this Fed meeting feeling bullish. I think we cleared the hurdle. Here's the thing. Wall Street wants the Fed to be married to this long-term rate cutting regime because Wall Street wants the liquidity, right? Liquidity is Wall Street's cocaine. They are addicted to it. Wall Street loves liquidity. They want more of it. It is their coke. It really is. So from that perspective, of course, Wall Street wants the Fed chair to marry himself to a rate cutting regime for the next 12, 24, 36 months. Heck, marry yourself to a rate cutting regime for the next 25 years, right? They would love that. That's, of course, what Wall Street wants. But the Fed's not going to do that. And anybody that expected Powell to do that is insane. The Fed chair cannot marry himself to a long-term rate cutting regime because who the heck knows what the economy is going to look like in 12 months, 24 months, 36 months? Who the heck knows what Fed policy should be in 12 months, 24 months, 36 months? It is prudent to not marry yourself to a long-term Fed policy stance, whether that's rate hiking, holding rates steady, or rate cutting. It's prudent not to marry yourself to that and instead take things on a meeting-by-meeting basis. That's just a prudent approach. You shouldn't be upset by that. Wall Street shouldn't be negative on that. Rather, Wall Street should do its job and figure out, okay, what is the economic data going to look like probably on a meeting by meeting basis over the next several meetings? Well, I think the data is going to be supportive of more rate cuts on a meeting by meeting basis over the next 12 months. I think inflation pressures will continue to remain pretty calm. I think that unemployment will continue to rise. I think labor market weakness, we've talked about it. I think it's AI driven job loss mostly. I think that's going to continue to spread. And if that happens on a meeting by meeting basis over the next several meetings, the Fed will continue to cut rates at all of those meetings. So I think we cleared the hurdle. Powell didn't sound that hawkish. He said we're on a meeting by meeting basis. If the data continues the way it is, and I think it will, they're going to keep cutting rates. I think we get 4 to 5, maybe 6 rate cuts over the next several meetings over the next 12 months, really. And that's more than enough liquidity to power the market higher. So I would be a buyer on this post-Fed dip, you could call it, although we kind of rebounded immediately out of it. So, I mean, where are we right now? I think the markets are actually higher. The Dow's higher, S&P's flat, Nasdaq's a little bit down. So, that's my general takeaway on that meeting. I think that any weakness we see out of it is a buying opportunity.
All right, Luke. So that did go according to what everybody thinks, or the last announcement did really go according to what everybody thought would happen. We thought we would get that rate cut. We did get that rate cut. However, I am curious about their projections on an unemployment decreasing when we've seen the BLS constantly reveal numbers where unemployment is on the rise. How do you take both of those ideas into one, and then also in terms of interest rates, those seem to be steadily rising as well. How do we take that data and invest with that?
Yeah, so I would say on the labor market stuff, I think the Fed's out to lunch on that. I just don't think they understand that. I mean, they're old school people. They're old people.
Right.
Not no knock against old people, but I just think younger people more potently grasp the AI jobs disruption that we are seeing, the AI driven jobs. It is a new dynamic. Textbooks did not teach that because it did not happen until now. So I just think that there are a lot of forecasters out there that are really misjudging the magnitude, underestimating the magnitude of the AI driven jobs disruption that we're seeing. So I think that forecast for unemployment to decrease in 2026 I think it's an out to lunch forecast. And that's why, though, I think that's bullish because that's why the Fed's only penciling in one cut next year. If indeed unemployment does decrease in 2026, the Fed should only cut rates one time next year. But I don't think that's going to happen. I think we're going to get continued labor market weakness, continued inflation softness, and that's going to allow for more rate cuts, what the market really wants, which is, 2 to 3 additional cuts in 2026. So that's my read on the labor market situation. The second thing about real-time rates have been dropping. The 10-year dropped from 4.3 to 4%. Now, after this meeting, it went back up to 4.1%. So I think a lot of this dovishness is now priced into the market. We're seeing in response mortgage rates drop. We're seeing mortgage application volume spiked. I think we just got the MBA report today. Mortgage application volume is running at its highest level since weekly mortgage application volume, highest levels since like the summer of 2022. But it's all driven by refi. It's all refi right now. Refi volume is at its highest since I think like March or February of 2022. Purchase volume is still very depressed. So you're seeing mortgage rates fall, but that's only enough to really get the refi market going. The purchase market is still depressed. That changes if we get more cuts and a further drop in mortgage rates. And I think we will. I think the 10-year, 30-year, long end of the curve is probably going to keep going down if indeed I am correct in assuming that inflation remains pretty soft and labor market weakness continues to spread even with these rate cuts. You're going to see the long end of the curve come down. So I think real-time rates are going to move lower. I think labor market's going to remain soft. I think rate cuts are going to keep on happening. And the investment implication of all that is to buy long duration assets. What benefits the most when the long end of the curve drops? Long duration assets that get most of their value from their future cash flows, right? The valuation of a company today is what its balance sheet says it's worth plus the net present value of future cash flows. When you have stocks where all their value is tied up in their balance sheet today, they're not that rate sensitive because those future cash flows, net present value, future cash flows, that's calculated with a discount rate that's dependent upon the long end of the curve. So when the long end of the curve goes down, if all your value is tied up in the balance sheet today and not the net present value of those future cash flows, your stock doesn't benefit that much. But if you're a startup, you're a younger firm, you're a firm whose balance sheet says you're not worth that much, but you're growing at 20, 30, 40% per year, and therefore all your valuation is tied up in the NPV of those future cash flows, then you are disproportionately a beneficiary of the long end of the curve coming down. So as the long end of the curve comes down over the next 12 months, you're going to see long duration assets, those hyper growth stocks, those AI stocks, those tech stocks, those stocks growing 20, 30, 40% per year. Those are going to be the biggest winners over the next 12 months in this rate cut regime as the long end of the curve drops.
Awesome. I think that's a perfect segue, perfect pivot into the next topic here. I want to talk about Opendoor, which kind of meets a lot of the merits that you were talking about in terms of potential future revenue. It has been under fire recently. The new CEO has been saying a lot of things. One of note is in terms of the labor market. He indicated, why do we have 1,400 employees? I think we can get away with 200. So I guess with your thesis there, do you think this shift in the Fed helps Opendoor in the future?
Yeah, so Opendoor's been on fire. That stock is now clearly above $10. Looking at the chart here, just do a quick technical analysis, and then we'll get into the fundamental stuff. $5 was a big level. I talked about that being a ceiling for the stock for 2+ years, 3 years, really. We knifed above that. Now we knifed above $8.50 as major minimum from back in January of 22, and a couple peaks here in early 22. Knifed above that. Now we're above $10. Remember, this was a SPAC, which means its first price was $10. So that's a big level to be above now that we're at 10. Now I see a gap. Now we're filling a gap up to 15. So I think this goes at 10 to 15 in a hurry now. And I think the fundamentals support even further share price appreciation over the next 12 months. So what we're seeing now is, remember, we talked about hope. Hope got this stock from 50 cents to $5, but execution was going to get it from $5 to $50. We are starting to see the beginnings of that execution. There has been complete management turnover. You have this former COO of Shopify has now taken over as the CEO of Opendoor. Now that's big because Shopify, remember, this was a stock that was an e-commerce darling for a while. Then the e-commerce boom kind of faded post-COVID, 22, 23, and they needed another angle to drive growth, to reinvigorate growth momentum of that company. And they found it in AI. And guess who was the COO at Shopify when Shopify found that renewed AI momentum? this guy, the guy who is now the CEO of Opendoor. So this is somebody who has a track record of reinvigorating technology businesses with AI and then sending that business to new highs. Shopify stock. I think he can do the same thing over here at Opendoor. He's all in with the concept. So that's the first big kind of execution change we're seeing. The founders are back, Keith and Eric Wu, very big and important tech players, especially Keith. They're back on the board. They raised about $40 million in financing from outside VC firms. So now we're seeing this execution. All that stuff is great. I love the fact that they're continuing to lean into the power of the retail investor. I think they scrapped their entire PR department, and now they're just going to be communicating with the quote unquote open door army through Twitter, through X. I love that concept. I love it because I think it's cool, but more than that, the company is realizing, management, the board, whoever's pulling the strings over there, they're realizing the amount of change they can affect by leaning into the retail crowd. They keep leaning into that retail crowd. They keep getting buying pressure, and that can change everything. So they're leaning in. They're leaning in all the way. The first sign of this, remember we talked about it, was when they pushed out CEO Kerry Wheeler, former CEO Kerry Wheeler. That to me, and I tweeted about this, I wrote my subscribers about this. That to me was the big moment. That was the moment that Opendoor, the people pulling the strings over there, again, management slash the board, that they were open to working with the retail crowd to affect positive change. And since then, that was the first domino. A lot of other dominoes have fallen. Now we got an AI guru at the helm. Now we got the founders back. Now we got outside financing. Now we're just communicating with everyone through Twitter, scrapping the PR department. We're talking about a lot of layoffs to increase profit margins, increase profitability, not having to rely so much on the spread. A lot is going right for Opendoor right now. Rate cuts will only help. If
Right.
mortgage rates continue to drop, that's only going to help. This model, the iBuying business model, did work throughout the 2010s, into COVID, and just after COVID in 2021, when the housing market was under normal-ish circumstances outside of that, post-COVID, during COVID kind of freezing of the market. Under normal-ish circumstances from 2015 to 2021, where you had normal home volumes, normal home supply, good buyer demand, regular HPA, home price appreciation, 2 to 4% per year. In that normal environment, the iBuying model really did work. Now we're getting back to that normal environment at a time when management is really looking at cutting costs, leaning more into the AI stuff. Everything is coming together at once at the perfect time for Opendoor, which tells me this big rally we've seen from 50 cents to $10, as much as you may want to chalk it up as just a meme stock rally, it feels like it's a lot more than that to me. And it feels like a stock that can go to 50.
For sure. I do have to ask, Luke, it seems like there's almost a decentralization of management in Opendoor, and then the CEO is kind of sloughing off what he considers the excess in the company. Is there a risk to that, though? Because it seems like to be a lot of reliance on that retail investor market to push the stock higher. Is there a potential issue that we could see with Opendoor that could happen, in the next 6-10 months or 6-12 months?
Yeah, I mean there is a risk, but the risk is all in the execution. If they execute, if they successfully transform the business model to more of an AI market making model, if they successfully gut 50% of the employee base without really losing any top line momentum and profit margins improve dramatically, if they do those things, then they're going to attract institutional investors.
Hmm.
It's all retail money that pushed this up from 50 cents to $10. What's going to happen when you get institutional money in there? And that institutional money will be much more, I don't want to say reliable, but retail money we know, comes in and out like the
Right.
tide. Institutional money is more like the big rock in the sand that doesn't move. So that money's much more, yeah, in some senses reliable when push comes to shove. So that's why I think the risk is in the execution. The risk isn't in the reliance on retail money right now. The risk is in the execution because then if they execute, the reliance on retail money diminishes and they get institutional money in the game. So that's where I think the risk lies. And obviously there is still a bunch of risk there, like no doubt about it. But I don't know. I got a good feeling about this one. You should never invest on a feeling or trade on a feeling, but I got a good feeling. I remember I was swimming in my pool a couple weeks ago. An Opendoor stock had that big rally from 50 cents to $5, and then that big intraday sell off, and it pulled back to $2 after earnings. And I remember I was just swimming and I was just reading things on X and Reddit and just going all over doing my research. Um, and then I went for a swim, and as I was swimming, I was like, this just feels right. Like something just feel, and then the rate cuts it just felt right in that moment. Now I wish I had done more personally to act on that at that $2 feeling now that we're at $10, but I still have that feeling. I still just it just feels like so many things are coming together at the perfect time. Business is all about timing. Everything is about timing. You can meet the right person in your life as a marriage partner at the wrong time and it won't work out. You can meet the wrong person at the right time and it will work out. It's all about timing. And right now, all of these positive business changes are happening at the perfect time with rate cuts coming into play, mortgage rates finally breaking down, the 10-year treasury yield finally breaking down, mortgage application volume finally breaking out of its slump. So much is going right for this. Of course, execution risks remain. They are large, but I think the stock's going high. I think they're going to pull it off.
I like it. Diamond hands with Opendoor, right?
Oh, diamond hands, the return of diamond hands. That'll tell you what type of market environment we're in.
For sure, for sure. So I want to go on to the next stock story, or one could consider it almost a person story. Elon recently did an insider investment of $1 billion into Tesla. We saw a rally. The stock is on fire. Now, what do you think of the Tesla story? You know, we have the projections from Elon regarding Optimus, and it's going to make Tesla huge. And with some of those, if the company hits some of those projections, Elon will become the first trillionaire ever. How do you feel about Tesla right now, Luke? And what's your outlook for the next year or two?
I love Tesla. I absolutely love Tesla. My Bloomberg terminal's being slow right now, so I can't pull up the chart for you. It's being wonky, but Tesla stock has a history, okay?
Mhm.
And the history is that it goes nowhere for 3 to 4 years before absolutely going vertical for 1 to 2 years, and then going nowhere for 3 to 4 years before absolutely going vertical for 1 to 2 years. It's done this twice now. When the stock first went public and they were going to create this big EV business, everybody doubted them. Everybody doubted Elon's bold claims about electrifying transportation. Everybody doubted they could bring a car to market. Everybody doubted that car would sell. And then they had, successful launches with the Model S and the Model X. And all of a sudden, whoa, maybe Elon's bold ambitions, he was right after all. And the stock just went absolutely vertical and it soared. Again, I wish I could pull up the chart for you, but my Bloomberg's being really finicky. Anyways, went absolutely vertical for about 2 years. So here we go.
Nice.
Let's see if this can. I got some lines here. Gonna get rid of these lines. Delete these annotations. Delete, delete, delete. Anyway, so the stock went nowhere for a while and then went vertical on the Model S launch. And then we went nowhere for a while after that because, okay, wait, the Model S is not going to make the company consistently profitable. They need a mainstream car. It can't be the super expensive car. And that's when he was like, well, you know what? We're going to make that mainstream car with the Model 3. Trust me, the Model 3 is coming. But nobody believed him. Absolutely nobody believed him when he said the Model 3 is coming. And I remember back in, what was it? 2016, 2017, so many people were like, this company's going to go bankrupt. There's nothing good going for it. Every quarterly earnings report wasn't a check-in on what deliveries were, but rather a check-in on how much cash the company had left. So people were just very not, they weren't in love with the stock at all. In fact, I would say most of Wall Street hated the stock. but then it went absolutely vertical. So here you can see the chart now. This is a log chart of it. Here's where the stock went nowhere from 2010 to about, 2013. Then we got that Model S launch, Model X in there, and the stock goes from $2 split adjusted up to $12 split adjusted. So, I mean, call it a 6x gain in a matter of a couple months. Then we went nowhere. $10, $12 split adjusted by late 2019, mid 2019, we're at $13 split adjusted. So we went nowhere for 6 years because everyone was worried about the Model 3. Elon said it's going to be the biggest car ever. No one believed him. And guess what? He did it. And the Model 3 launched and it was a raging success. And everybody and their best friend bought one. And it did become arguably the best selling car ever. And then boom, from middle 2019 at $13 split adjusted. And by late 21, we're at $370 split adjusted. So this massive straight line rally. But now look where we are. Now we're flat. Boom. Ever since what? So we hit 370 in late 21. We're at 425 now. So we've been flat for 4-ish years. 4 straight years. Tesla stock has been more or less flat. Very consistent with this flat stretch back in the early 2010s, this flat stretch in the mid 2010s. Well, now I think we are due for one of these rallies, like we saw from 2019 to late 2021 with the launch of the Model 3, like we saw in late 2012 to early 2014 with the successful scaling of the Model S, Model X, models like that. What is going to drive this rally? Optimists, and dare I say, Optimus. Optimus is so it was the Model S, Model X, the Model 3, Optimus. That's the value unlock here. Optimus is scaling nicely. I think we're going to get deliveries in 2026. That's going to wake up Wall Street to its real potential. We're going to get consumer deliveries in 27. And as Optimus goes from this thing we see on Twitter, on X, in these videos, in labs, in Tesla gigafactories, as it goes from that to something other companies are using, to something I can buy online myself, that's going to happen between late 25 and late 27. That 2-year stretch is going to be a 2-year stretch for Tesla stock, like late 2019 to late 21, like late 2012 to early 2014. I think this stock is about to go parabolic, and I do think Elon Musk will become the world's first trillionaire.
Roger that. Okay. Bet on Tesla. Now, I do want to move over to another topic, cloud computing. Nvidia just recently struck a major deal with CoreWeave for about $6 billion or so. Microsoft also announced another deal. Well, what's the trend here? We got these large FANG stocks making these investments in cloud computing. How do we play this?
Oh man, I love this story because what these deals emphasize is that even though the AI hyperscalers have this massive bazooka, right? This massive bazooka of money that they are just shooting nonstop into creating more AI infrastructure. I mean, I think the number was over $400 billion spent by the hyperscale 5, the big AI hyperscalers, over the next 12 months on AI infrastructure. So, and then that number is going to go up. And it's going to go up. So we're talking trillions of dollars over several years. Even though they're spending all of this money, AI cloud compute still far exceeds AI. AI cloud compute demand still greatly exceeds AI cloud compute supply. And that's why Nvidia has to go over. Nvidia's, trying to tap all these data centers. They have to go over to CoreWeave and say, hey, if you have any excess capacity at all, please let us buy it. Here's $6 billion. Let us buy any excess capacity you have. Microsoft goes off, I think that company was called NewScale out in Norway. Please, if you guys have any excess AI infrastructure, we're trying to build data centers out here in Europe, but if you have any excess cloud capacity in the meantime, please let us have it. Here's $6 billion, right? Like that is literally what is going on. These AI hyperscalers are begging to rent GPUs, to rent cloud compute from companies that have it. Wherever they can find it, they are just paying a premium for that. What does that mean? you got to invest in those excess cloud compute players. You got to invest in Nebius. You got to invest in CoreWeave, Astera Labs. These are stocks that have been absolutely on fire that will continue to be on fire because AI cloud compute demand is vastly outstripping AI cloud compute supply, even with the AI hyperscalers spending hundreds of billions of dollars a year, trillions of dollars over time on building more supply. Eventually, the supply will catch up to the demand. We'll be in a more equal market. But that we are a long ways away from that. Just sit back and think, okay, how many companies are using AI today? Probably 99% of them. But how much are they using AI? Maybe 20%, maybe 10%, maybe 15%. That could go up to 80, 90, 95%. So you got 99% of companies that are maybe using it at a 15% rate, probably. That can go up to 85, 90, 95%. 99% of companies doing that. So that means demand can still go up by a factor of 4, 5 over the next several years. Will supply go up by a factor of 4 or 5? It's going to take a long time to get there. So there is a multi-year window here where I believe AI cloud compute demand will outstrip AI cloud compute supply. And that means anybody who is providing AI cloud compute supply will be able to sell that supply at a massive, massive premium. High revenue growth, high margins, big profits, big cash flows. CoreWeave, Nebius. Those are the two picks for this. I love both of those stocks.
Awesome. Yeah, I was just going to ask which ones were your favorite, but there you go, CoreWeave and Nebius. Which
CoreWeave and Nebius. I think Nebius is number one in my view. I call them the Ferrari. Oh no, you call them the Ferrari of I call them the Louis Vuitton. You call them the Ferrari. I like Ferrari way better. They are the Ferrari of AI cloud compute. And CoreWeave is, we'll call them the
Toyota.
no, it's Lamborghini. It's Lamborghini, maybe Aston Martin. It's up there, right? It's still very strong. I just think they're a little bit bigger. And so they're not as specialized, but nonetheless, they have massive deals. They have all the GPUs. They got the great partnership with Nvidia. I think that is a strong company. So at CoreWeave and Nebius.
Awesome. Okay. Now, kind of bringing it back a little bit to vehicles. The Robotaxi war is continuing. Lyft just partnered with
Yeah.
Waymo to launch robotaxis in Nashville. What does that mean for Lyft? You know, Waymo and Uber had this partnership. It was really strong. However, it seems like Waymo is veering away from Uber. Does this mean we should play Lyft? Where do we go? Where do we steer in the future of the Robotaxi wars?
So I remain skeptical of Lyft. Now, here's what I think is going on. When all this started, Uber and Waymo, they got married. Okay. And they were in an exclusive relationship, more or less. Every time Waymo wanted to launch in a city, they did so through the Uber network. It became a almost inseparable pairing. You knew that if Waymo was going to launch somewhere, they were going to launch with Uber. But then Waymo tried to not open up the relationship, but go at it by itself. They tried to launch in a few new cities without Uber. They tried to launch through their Waymo One app. And of course, that created some worries at Uber. It's like, wait, these guys are trying to go at it alone without us? Well, you know what? If you're going to open it up a little bit like that, then so are we. So then Uber went out and started partnering with Baidu and partnering with Lucid Emotional and partnering with all these other robotaxi companies across the world, basically telling Waymo, hey, if you want to break the exclusivity, the implied exclusivity of our partnership, then we are too. There's more than one horse in the robotaxi race that's creating autonomous vehicles. Okay, so then Waymo's like, well, if they're going to go and try and do that, then we're going to step up our opening up of the relationship efforts, and we're going to go partner with Lyft. And so now they're like, all right, we're going to launch, robotaxis through Lyft's network in Nashville in 2026, not through Uber's network. So I think kind of what's happening is just these two companies are kind of going tit for tat, eye for eye, just keep up in the ante on one another. I'm going to cheat on you. No, I'm going to cheat on you. Now I'm going to cheat on you. Right? It's just kind of like, but at the end of the day, they're the perfect marriage. Okay. And I think they're going to realize realize that they're perfect for each other because what's going to happen is Waymo is going to launch in Tennessee through Lyft, and the utilization of those cars is going to be horrible relative to the utilization of the cars in the Uber network because the Uber network is so much bigger than the Lyft network. And if I'm Waymo, maker of these very expensive autonomous vehicles, and I launch them in a new city, I want them to be making as much money as possible. They need to have a high utilization. The utilization rate, I'm going to imagine, on the Lyft network in Nashville, Tennessee, is going to be significantly lower than utilization on the Uber network in Phoenix, in LA, in San Francisco. That's just how this works. When your network is smaller, you get a lower utilization. So Waymo is going to do that, and they're going to realize, oh man, there's a reason. I miss Uber. I miss how good they were, right? And so I think Waymo is going to come running back to Uber. And then Uber is probably going to launch with these other companies outside of China. I think Baidu and Apollo Go got a good thing going. But they're going to launch, I think they did a company in London. I think they did the Lucid Motional deal. I think they're going to launch these, and then they're going to be like, you know what, these cars kind of suck. They're not Waymos. Waymo has the best tech in the game. So then Uber is going to come running back to Waymo like, oh, I miss how good their cars were. I miss how safe they were, all that stuff. And so they're going to come running back to each other after all this drama is over. And at the end of the day, that marriage is going to work. And I think that marriage is going to dominate the Robotaxi Wars. So how do I play this? Well, Google, Waymo, and Uber. I think Uber is still the big winner here. I remain skeptical of Lyft. They just do not have the network advantage that Uber does. Now, having said that, Lyft stock has been absolutely on fire. I mean, the stock's gone from $10 to $22 in a couple months. And the breakout looks super legit if you look at the chart, right? I mean, this is a stock that got absolutely decimated. This yellow was kind of its channel for a while, and boom, it just broke above that in a meaningful fashion, broke above this big low from April of 2020 as well. So technically, this looks like a really strong breakout. It could fill a gap now up to 34. The short-term momentum is definitely with Lyft. I'm not saying the stock can't go higher. I think it can, maybe even push up to that $35 level in the next few months. But long term, several years out, Uber's the winner, not Lyft in the Robotaxi Wars. And Waymo, Google is always going to be a winner here because they have the best tech in the game.
Awesome. That's the rom-com I did not know we were watching, the way you explained it.
Yeah, that when I read it, that's immediately I thought of a rom-com. That's what I
Yeah.
immediately thought of, right? It's like these guys were married and now they're just trying to, one up each other, but they realize at the end of the day that they're the best partner for one another because one has the best network and one has the best car. So marry up, fellas, marry up.
100%. And I think Uber did strike a deal with Joby, right? So they're going to have flying cars. Why wouldn't you want to be with the guy with the flying cars?
Yeah, Uber's an investor in Joby. Obviously, I love Joby. I think it's a good long-term stock. The story there is Uber had a flying car division way back in the day,
Right.
when they were trying to be super innovative and pushing the envelope on everything. Remember, they had a big leadership change. Travis Kalanick was the founder and CEO. He got pushed out. Now Dara's there. Dara's more of an operator. Travis is more of like an innovator, push the envelopes guy. So that transition is kind of what led to the folding of the flying car unit. But that flying car unit folded into Joby. So then Uber became a massive investor of Joby or in Joby. So that's the Uber Joby connection. But yeah, I think Joby's going to eventually join the Uber network too, because hey, if I make these super expensive eVTOLs, same argument as self-driving cars, I make these super expensive eVTOLs, I'm going to want to plug in to the network that's going to get them the most utilization. That's Uber. So Uber to me is, I mean, they're a network dominator, and I love that stock for the long run.
Awesome. Okay. I want to move on to the next stock story here. Tesla is back at it again. So they just struck a deal with EchoStar, who was previously in the news for striking a deal with AT&T. They've just been kind of selling off their wireless spectrum. But that deal, pretty big. How do we think Tesla is going to play that? Are we going to see a Tesla phone network rivaling T-Mobile or Verizon, or what does that mean for the Tesla ecosystem? And then how do we play that, obviously?
Yeah, so first off, it's SpaceX. SpaceX bought that wireless spectrum. So SpaceX bought 17 18 billion, maybe 17, I don't know, 17 or 18 billion dollars worth of wireless spectrum from EchoStar. Now they're going to take that wireless spectrum, combine it with their Starlink satellites, and create a direct satellite to cell service. For those of you that have followed my work for a long time, you know that AST Space Mobile is already doing this. They are already doing direct satellite to cell. So now there's two horses in this race. I think that is the future of telecommunications, of cell service. We are not going to have this is a pretty bold claim. We are not going to have local telecom operators. I think T-Mobile goes the way of the dodo. I think Verizon goes the way of the dodo. I think all those brands go the way of the dodo, and they get replaced by one global carrier. Whether that's Starlink or AST Space Mobile, I think these regional ones turn into global ones. Now, where that gets tricky is okay, of course, here in the United States, there are going to be no issues with choosing Starlink or AST Space Mobile over a T-Mobile, an AT&T, or a Verizon because they're U.S. companies. Where you can things get really tricky. So I think the disruption definitely happens in the U.S. Where things get tricky is internationally. Because internationally, like in Europe and South America and Asia, some of the biggest companies in those regions are the telecom companies. Are the governments of those countries going to be okay with their biggest companies being disrupted by a US company, by Starlink, by AST Space Mobile? Probably not. So there's probably going to be rules and regulations that prevent it from being a true global carrier for the entire world. But I think, a global carrier for US folks, i.e., I just need this one carrier and I can now get consistent cell service across the entire globe, regardless of where I am, Antarctica, in a plane in the middle of the Pacific. I'll get cell service because I'm with Starlink or I'm with AST Space Mobile. So I think that's a massive upside win for those companies. I think it's a massive loss for the Verizons of the world, the T-Mobiles of the world, the AT&Ts of the world. When it comes to the question of who wins between AST Space Mobile and SpaceX and Starlink here, that's much trickier because Starlink has the satellite advantage. Their constellation of satellites is much larger than AST's. That's a huge advantage. AST can catch it, but it's going to take time and money, resources to do that. The advantage AST has is that their satellite to cell service works with existing phones. You do not need additional hardware on this thing to make that work. SpaceX is saying they need additional hardware. And reports are out that they're working with chip makers, no names, I think Qualcomm, that they're working with chip makers to develop specialized chips that can go into phones and the next generation of phones to allow their satellite to cell service to work. That's going to take time again. So both of them have different advantages. And in order to catch the other one in the advantage that they do not have, it's going to take time. So from that perspective, I think both can win at least for the next 5 to 10-ish years. Maybe after that, they rub elbows a little bit more intensely and one actually beats out the other. But I think for the next 5 to 10 years, both AST Space Mobile and SpaceX Starlink can win in this satellite to cell battlefield, if you will.
Got it. I got to ask, Luke, what is the timeline we're looking at for, either ASTS or Starlink to start eating up that market share of the bigger providers? Because I'm just speaking anecdotally here. I have not met anyone in person that has AST as powering their phone. And I've only seen maybe 1 or 2 videos of people with Starlink and they're using them. And one of those videos was actually kind of funny. The guy kind of hacked his Starlink router so he can get Wi-Fi on a road trip. So what's the timeline we're looking at here for these companies to start taking dominance?
AST is already operational. AST is operational in select markets in a partnership, I believe, with AT&T. It is. So AST is operational. Now it's more like a backup thing. It's not like it
Right.
takes out all of your AT&T service. It's like when you lose AT&T service in certain areas, you can now dial into the AST one and you have to buy a certain plan, I believe. So it's like a premium charge. So it's niche and expensive, but the AST service does exist. In terms of the SpaceX one, we know that it's going to require new chips. So that's a whole product upgrade cycle away, at least one whole product upgrade cycle away from that becoming a reality. So I think we're about 2 to 3 years away from this becoming not a ubiquitous reality, but a semi-ubiquitous reality where satellite to cell service becomes a thing that most people have access to and that a lot of people do use on a regular basis.
Got it. Okay. Just curious there. Now I do want to move on to our, stocks of the week, our breakout stocks here. One we've talked about before, Bloom Energy, to lead the pack.
Yeah, let's do Bloom Energy. Let me pull up the chart here. Bloom Energy. So the fundamental story here is on site backup power for data centers. And I like that story because we've all talked about the power demands and energy demands of data centers. We need lots and lots and lots of power and energy to make them work. We think that nuclear is going to be the go-to power source for these AI data centers. It's going to take a while for nuclear to become the backbone. It takes a while to build SMRs, even longer to build big reactors. So there's a gap in there. Natural gas will fill that gap. So that's the power generation foundation of the AI data center boom. But you need backup power. You need power on site just in case a reactor goes down and you're not on the grid. Just in case a natural gas plant goes down and you can't pull power from the grid. You need on-site backup power. That's what Bloom Energy provides. And the market has very clearly, look at this, fallen in love with the stock. This has gone from, this is a $15 stock in May, and it's an $80 stock today. This has been one of the biggest, let's add the RSI, you can see how overbought it is. This has been one of the biggest, get rid of the volume bars. There's a cleaner look at it. This has been one of the biggest short-term rallies I've seen in the recent stock market history. As you can see, the stock's been around for a while, kind of went nowhere for a long time. IPO'd at 15, and as of May of this year, it was 15. So nowhere for about 7 years, and then all of a sudden, 15 to 70, 15 to 80. This is the power of the AI boom. As it relates to Bloom Energy stock, I like it. I think there's a lot of long-term potential here. I wouldn't be a buyer of it with an RSI of 85. Wait for a pullback, look to buy on pullbacks. That's how I look at Bloom. But I think the bigger lesson here is there are so many facets and niches and verticals of the AI boom. And all of them, most of them, are making a ton of money. On-site backup power for AI data centers, that's as niche of a vertical that you could get. And look, it's birthed a stock that's gone from 15 to 80 in months. This is the power of the AI boom. This is why you want to be invested in AI stocks. This is why we say AI with AI. Next.
Yeah, next up, speaking about power, we got Oklo.
Yeah, so here's another niche of the AI boom. Oklo talked about nuclear. This stock has gone nuclear. Big rally this week off the 50-day moving average. Nice bounce, boom, 70 to 95. Love that action. The uptrend here is very much alive and well. No need to look at its pre-SPAC days or pre-IPO days, really. Great uptrend, 50 days to support, nice bounce off of it. I think this is a very big long-term winner. Again, the bull thesis, I think SMRs are more particularly the future of AI data center power as opposed to these big reactors. Big reactors are cool and all, but data centers, they're getting built in these kind of random places where land is cheap. You don't want to have to tap into like, hey, are you going to be able to tap into a nuclear reactor that's nearby? Is there a nuclear reactor nearby? You don't want to build a big nuclear reactor just to power a couple of AI data centers. So what you're going to do is you're going to build SMRs. You're going to build these. You build data center, you build an SMR. You build data center, you build an SMR. You build data center, you build an SMR. So as these big data centers get built in these sort of remote areas where land is cheap, you're going to build an SMR right next to them. Oklo is a leader in the SMR game. NewScale is the other one. NewScale Power, ticker SMR. Those are the two big dogs, in my opinion, in this race. Oklo is my preferred play honestly, because of Sam Altman. Like Sam Altman was part of this company, was the chairman. He stepped down to allow for him to make more AI deals. I think Sam Altman is really getting cozied up there in the White House. I think he's becoming a preferred person. So I think as more and more deals flow through, I do expect some energy AI deals, and I think Oklo can win a lot of them. So I really like the long-term thesis on Oklo. In the short-term setup, not too shabby. Definitely top side of the channel right now. RSI is 73. Don't chase, but this one has pullbacks to the 50. It does that often. Wait for a pullback to the 50-day moving average. Buy it on pullbacks to its 50-day moving average.
Fantastic. Okay. Next up, we have a chip story here with Rambus.
Yeah, I like Rambus. Rambus again. There's that bazooka. This is right in the bazooka. Stock has gone absolutely vertical. I do not like a short-term setup because this is not a stock that has really vertical moves. So this is a really vertical move in a stock that does not do really vertical moves all that often. Don't chase that. RSI 75, don't chase that. But the long-term story here is very, very nice. The long-term uptrend is very, very nice. I think this one continues to push higher. This one probably hits its head on 100, has a pretty big pullback, I would think. That pretty big pullback is going to be the time to enter Rambus. Keep this one on your radar. Do not chase it here. Again, though, big bull thesis. We talked about the AI cloud compute spending that's going on and how demand just outstripping supply. So these guys are just going and begging for excess cloud compute supply from anywhere. $6 billion to you, $6 billion to you. They're like Oprah handing out checks for cloud compute supply. Rambus is a beneficiary of all that because it means a lot more spending is going to happen in terms of building more cloud compute supply. And that's, again, Rambus is just so integral to that. So the stock will keep on winning long term. Short term, RSI 75, big vertical move, don't chase, buy on pullbacks.
Roger that. Okay. Next up, we got a quantum story in Rigetti.
Yeah, so quantum's been hot. Quantum's been red hot. I think the Department of Energy just announced a big deal with IonQ and Honeywell to bring quantum into space. That's going to be for secure communications, right? Because a big thing here is QKD, quantum key decryption, and I think a big, the theory is that with quantum computers we can make comms unbreakable.
Right.
So why not start in space where we have a lot of comms? Let's make those comms unbreakable. So I think that's what the Department of Energy is getting at by bringing IonQ and Honeywell quantum computing capabilities into space. But more broadly for the quantum computing field, it says, hey, this stuff is very definitely, without a doubt, inarguably jumping from science lab to real world applications. The commercial era of quantum has arrived. Commercial quantum is here. Stock red hot. What I love about this move in Rigetti is cleared that all-time high. Yeah. Had that all-time high of $20 in January 25. Huge pullback. Rebound. Bam. Cleared it. This is one that wants to keep on going higher. I have my quantum for Rigetti, quantum computing, QUBT, D-Wave systems, QBTS, and IonQ, IONQ. That's the quantum 4. All 4 have been hot. All 4 will stay hot. My favorite is IonQ. They have the best tech, most commercial progress so far, most commercial partnerships, biggest revenue base. I think the most experienced and impressive team. So that's if I had to pick a horse in the race, that's the one I'd pick. But I think all 4 of these stocks, they move in tandem. They're highly correlated. All 4 should continue to do quite well. And then bringing it back to the Fed, what does well when the long end of the curve drops? We talked about it. Long duration assets, long duration stocks. There is no such thing as a more long duration stock than quantum. There is no value in the balance sheet today. All of the value of the of these quantum stocks is tied up in the net present value of the future cash flow. So long end of the curve comes down, these are the types of stocks that will win very big.
Awesome. Okay, now we got a crypto story here in a sense, something we talked about a little bit last week. It's BMNR.
Yeah, B minor. It's a bit mine. We talked about B minor. B minor is the Ethereum or the strategy of Ethereum, the micro strategy of Ethereum.
Mhm.
I love the story because we need a micro strategy of Ethereum. We talked about last week how these crypto treasuries, like they're a sign of a bubble, and I do think they are the sign of a bubble that is forming. And I think a lot of them are complete BS. B minor is not one of them. I think strategy is very legit as the Bitcoin holding company, and B minor is very legit as the Ethereum holding company. Now you have all these other offshoots of Chainlink and all that stuff, and I don't want to get into that because I think those companies are poorly run. I don't think they're companies that will succeed in the long run. But B minor is not that. It falls more into the strategy camp. Strategy has done very, very well for investors as Bitcoin prices have risen. B minor stock should do very, very well for investors as the price of Ethereum rises. And I think the price of Ethereum is going to rise quite a bit. I think the price of Bitcoin is going to rise quite a bit. I think all of cryptos are due for a pretty big melt over the next 12 months because those are also risk assets that benefit a lot from the long end of the curve dropping, from a rate cutting cycle, from risk appetites becoming more and more aggressive. People pile into cryptos. They pile specifically into altcoins. So you get this kind of risk waterfall as you kind of go down the ladder from Bitcoin to Ethereum to XRP, Solana. You just keep moving lower and lower and lower and lower and lower. I think there's a lot of money that'll flow throughout the entire altcoin universe. And I also think you got a lot of good things going on with stablecoins. The Genius Act, the Clarity Act, there's a lot of positive movement on Capitol Hill. And I do believe that all of that positive legislation will create a framework and an impulse for companies to more broadly adopt and deploy stablecoins. I think Walmart gets into the game. I think Amazon gets into the game. I think what MasterCard and American Express and all those companies, they're going to double up, triple up on their efforts. I think you're going to get a lot of growth in the stablecoin market over the next several months and even several years. I just read one study from Bloomberg Intelligence that said total payment volume of stablecoins could hit $50 trillion by 2030, accounting for 17% of total global transactions. That's massive. Now, I think that's a bit aggressive, but that is, if you could get just a fraction of that, that is absurd growth from where we are today. Less than 1% of global transactions are handled through stablecoins today. If you get to 10%, that's 10x. Bloomberg thinks we get to 17%. That's a 17x, more than 17x. Like, we're talking massive growth there. And then tokenization is the other vector of growth in the crypto universe that I think is going to be really big. Robinhood, we talked about it last week, talking about tokenizing equities. I think that's massive. I think we're going to get a lot of tokenization stuff. Also, with positive, kind of a positive regulatory backdrop that will allow tokenization related cryptos to soar over the next 12 months. So I like B minor. I like stablecoins. I like tokenization. I like the whole crypto space for the next 12 months.
Gotcha. Now, I do have to ask, I'm speaking on behalf of maybe somebody that's just getting into investing. Why would I want to invest into strategy or MicroStrategy, as it was formerly called, or BMNR, when I could just invest into Bitcoin or Ethereum?
Yeah, so they're levered plays. They're levered plays on it. So strategy always trades above the value of the Bitcoin it holds on the expectation it'll keep buying more Bitcoin. B miner will trade above the value of the Ethereum it holds on the idea that it'll keep buying Ethereum. So these are companies that have earned the trust of the market to keep on. B miner less so than strategy because it's newer. Strategy definitely has. I think B miner well earned that trust. That they're just going to keep on buying Bitcoin and they're going to lever up on that stuff. And so when you lever up on that, you become a levered play on it. Strategy, when Bitcoin goes up 10%, strategy goes up more than 10%. When Ethereum goes up 10%, B miner goes up more than 10%. They're levered plays on it. So if you're looking for leverage, a little bit more torque, a little bit more juice to your Bitcoin or Ethereum trades, B miner and strategy are the way to go, or are one way to go.
Interesting. So it's almost like a strange options play in a sense.
Yeah, it's like a leverage ETF, a 2 times leverage ETF, a 3 times leverage ETF. I think it's probably the best way to look at it because it's not an option. There's no expiry on it, right?
Right, right.
So it's more like a levered ETF.
Great. Okay. That covers it for our breakout stocks of the week. We don't have any questions. I want to throw it to our audience. Of course, definitely comment in what you're interested in, what you're interested about hearing. Is there a stock story you're curious about? Anything of that nature. And now, Luke, is there anything we might have missed over the past hour that you might have wanted to talk about this week?
I think we covered a lot of ground. Again, the Fed is going to suck the oxygen out of the room this week. It's all about the Fed. I like what they had to say. I think it's good enough to keep the markets in rally mode. We are going to get multiple rate cuts. A lot of great news in the AI world. A lot of great news in the tech world. I'm very interested to see in about 10 minutes. Actually, I think Meta is going to host their big event where they're going to unveil those hypernova. Are they called hypernova or super? I think they're called hypernova or supernova something Nova glasses
Right.
that are going to actually have holographic displays. Really interested in that. We'll talk about that next week. So keep your eyes on that. Physical AI movement, Unity software stock we've talked about before. That's been red hot too. We'll touch on it next week. So a lot of good things happening in the tech world. A lot of good things happening, I think, on the rate cut front, on the long end of the curve as well. I think all of that means stocks are due for a really nice rally here in Q4. I'm optimistic. Again, got to be a little bit concerned about the next 1 to 2 years, given how bullish things are right now. Booms don't last forever. All booms turn into bust. But for the next few months and probably a few quarters, I'm not foaming at the mouth bullish, but pretty darn bullish.
Yeah, it's hard not to be bullish when you see, constant stories of 30 plus percent pops here, 50% plus pops there. But it is a nice time, like just on a general level, you got quantum computers being built in space. We got AI just blowing up. We got flying cars that are actually going to happen, autonomous vehicles. So it's still a fun time to be alive if you're just curious about technology in any kind of way.
Precisely.
All right. That wraps up another week of Being Exponential. Thank you for watching. We've definitely had a great time filming. We'll see you next week. Take care.